Today, I'm coming to you with a warning, and it's a warning that's actually quite simple. I'm going to show you the one thing that you should be watching every day. That one thing is interest rates. That one thing specifically is the yield on the 10-year Treasury note. That's something you can watch every day. And when that yield is going up, when the notes are going down, it is going to put pressure on stocks. It is going to make the stock market go down. After I've shared all this with you, how do you use this? As I said, you can be watching what is happening in the yield in the 10-year Treasury note and what is happening in the price. Watch specifically around the catalysts of the major economic numbers. We have CPI, the Consumer Price Index. This is one of the big catalysts for the month of January. If CPI comes out hawkish, if it comes out hot, interest rates are going up more and the market is going to get clobbered. If it comes in cool, if it comes in light, lower inflation, that could be a massive boost for the market. Now, the backdrop of the market has been, in general, to be bullish. The market wants to be bullish. And frankly, we're in this stage right now. If we get a dovish catalyst where inflation is lower, the market could launch. It could really take off. But it's also in this stage that people are in hope mode. They're hoping that it will stop going down. And we're not that far away. We could have a really hot, very hawkish print in CPI, and that could be enough to put panic into people and the market to get crushed. So we're at an inflection point. If we do get a dovish number, a lower inflation rate number, you want to be really on top of that. Watch the price action in the note, in the 10-year note, and watch the price action in the S&Ps. And if the S&Ps really start to rally off of that, that's a sign that you could be getting in, being really aggressive to get long again. But wait until you see that. A lot of money's lost, people going early. Wait. So watch your catalysts. We'll have core PCE coming up, and then watch the trend. Watch what the price action is in the 10-year note every day. And this will help you immensely. After the election, when President Trump won the election, we actually set up an environment that looked like it was going to be incredibly bullish for stocks. But there was one issue that we kept warning our students, kept warning our subscribers about, and that was what was happening in the interest rate markets, and specifically what was happening with inflation. We went through a period in 21 and 22 where inflation was the highest it had been in 40 years. The inflation rate had got to 9%, something that we had not seen since the 1980s. Now, it's been coming in, inflation had been coming in since 2022. And there's a belief that inflation was going to continue to revert and go all the way back to where it came from. And as inflation was coming in, the Federal Reserve shifted. They went from a stance of raising interest rates and talking about higher for longer. They did a pivot. And when they pivoted, that's when the market took off. This goes back to October of 23. You'll see when the market really started to rally is when the Fed pivoted. And when they pivoted, the market took off. And right away, the market was anticipating lower and lower interest rates being guided by lower and lower inflation. The problem is that the inflation stopped coming down. And the Fed cut rates anyways. And when they cut rates anyways, with inflation not coming down, that actually put more fire on inflation. And now inflation has started to uptick. So as a result, the interest rates that's demanded in all debt instruments, but particularly United States Treasuries, has been going up. And as a result, because interest rates have been going up, this has thrown water on the whole thesis of the stock market going through another bull boom post-election of Donald Trump. Now, this is something that we've been warning our people about now going back several months, and we've been all over this in the last month. This was a very key meeting, and you can see we talked about this on our YouTube channel. The FOMC meeting in December 18th was a big meeting because all of the verbiage around what Fed intentions were flipped. There was a belief that the Fed was going to cut interest rates 4 times in 2025. In that meeting in December, they backed off and it went from 4 to 2, which is a pretty significant change. And off of that, Off of that meeting in December 18th, stocks got clobbered. Interest rates started going up. Stocks kind of got their footing. They tried to rally a little bit going into the end of the year. But now, as we've got into late December and January, interest rates have continued to climb, and it is pulling the stock market down. It's pretty much linear. If rates are up, stocks are going down. So, and there's some reasons for this. If we look at just simply the value of a company versus the value of a bond. If we're going to own a company, we have a lot more risk. That company is going to have variability in profitability. It could make money, it could lose money, and it could even go bankrupt. We literally run the risk of bankruptcy when we own a company. When we own a Treasury bond from the United States, it's highly, highly, highly likely, even in the doomsday scenarios that people talk about, it's highly likely that you will get all of your principal back. So here you have a sure thing that you're going to get your money back and you have an interest rate. We've been in an environment now for some time that the rate that you get for owning a stock, you can call it the dividend yield or the earnings yield associated with a stock is less. It's less than a Treasury note or a Treasury bond by quite a bit, by almost 200 basis points. So what does that mean? That means that you can own a bond and get 4.5% or 5%, no risk, or you can own a company with lots and lots of risk and get 2.5% or 3%. Now, people have some reasons why they might do that, but here's the problem. If rates keep going up, then that is going to drag the earnings yield of companies higher as well. They can't stay this cheap. So if the earnings yield of a company is going to go up, how does that happen? By the stock price going down. Company's going to continue to make the same amount of money. The only way you get the yield up is the stock has to go down. You have to buy it cheaper. So this is the warning. This is the one thing that can derail the bull story, which is that you have an environment of inflation upticking. You have an environment where the federal government is spending more money than they ever have by far, that was not in a war or in some kind of great financial crisis. You go through, we can look at World War II. We can look at the Vietnam War. We can look at the great financial crisis in 2008. We can look at COVID. Those are points where the government spent a lot of money relative to the GDP or the output of the economy. But other than that, it's usually muted. Well, here we are in a period of strong economic growth. And what's the federal government doing? Spending like crazy, spending like we are in a major recession, spending like we are in a war. They are maxing the credit cards. And what happens when you max your credit cards? The only way you get more credit cards is at a higher interest rate. People are looking at this and they're going, I'm not going to loan the federal government money for 5 years, 10 years, 20 years, 30 years at 4.5% or 5%. I'll do it for 3 months. I'll do it for a year and I'll be really excited about that. But I'm not going to loan them money for 4.5% for 10 years. It's just stupid, especially when there is no fiscal responsibility. So we have this backdrop. That we have inflation rising. We have the government spending more than ever. Oh, and there's one more thing. The one more thing is the Federal Reserve. When we hear about what the Federal Reserve is doing, it's actually not accurate. It's very interesting. There's two ways that the Federal Reserve can stimulate the economy or cool the economy. There's basically just two ways. One is by where they set interest rates. Now, remember, they can only set interest rates short term. They can set interest rates overnight. They can set interest rates for 15 days, 30 days. They have a lot of influence over interest rates right now. But when we go out in time, when we go out to 2 years, 5 years, 10 years, 30 years, they don't control that. The market does. Okay. So, but they can influence through rates. So the whole story has been the Federal Reserve has been cutting rates. When we cut rates, that's usually bullish for the market. It's usually bullish for the market. When they raise rates, well, that's typically bearish. One thing that's been really interesting is the Federal Reserve is cutting rates. Rates are coming down in the short end, but the long-term rates are going up a lot. So when we talk about rates going up, they're going up out in time. They're going out at 5 years and 10 years and 20 years. This is very abnormal. Usually when the Federal Reserve cuts, all rates come down. But we have this period, we have this thing where short-term rates are coming down, long-term rates are going up. They're not just going up, they're going up a lot. So bring it back to what I said. The Federal Reserve can influence the economy two ways. They can cut interest rates or they can raise interest rates. Cutting is stimulative, raising rates cools the economy. The second way they do it, and in my opinion, this is the most powerful way they do it, is that they can create money or they can destroy money. We have the money supply. A lot of people talk about the government printing money. That's not true. The government can't print money. The government has very little ability to create money. The Federal Reserve creates money. That's what the Federal Reserve does. They literally can make a digital entry in a ledger and put money into a bank or put money into the Federal Reserve. From this digital entry, how does that money get into the economy? They take this digital entry and they go and they buy bonds. They go and they buy notes. So what happens? If I go and I buy a Treasury note from you, let's say I buy one Treasury note, I have to give you $100,000. Let's just say that's the face. I have to give you $100,000. Well, now I've put $100,000 into the economy. So the Federal Reserve increases the money supply by inventing money and then buying bonds. If you go through and look, the money supply exploded during COVID. Essentially, 70% of all dollars ever created, I'm talking about the history of the United States, 70% of all dollars that were ever created were created in 2020 and 2021. That is mind-boggling. The money supply exploded by design to try and save the economy. Okay, it went to $9 trillion. That was the size of the federal balance sheet, $9 trillion. So now what has started happening in 2022, 2023, that gets very little attention, is the Federal Reserve has been shrinking their balance sheet. So if I want to stimulate the economy, if the Fed wants to stimulate the economy, they make the digital entry, they buy bonds, and they put all this money into the economy. As we said, $7 trillion into the economy. If they want to cool things down, if they want to slow down the economy, then what they do is they turn around, they own all these bonds that they bought. What do? They sell them. When I sell you the bond, you have to give me $100,000. And now that $100,000 is out of the system. It's now gone. So the Federal Reserve has $9 trillion in bonds. And what are they doing? They're selling them and selling them and selling them and selling them. They have reduced the money supply by 40% in the last 2 years. So even when they're cutting rates, which is supposed to be stimulative, they're selling bonds and shrinking the money supply. So why does this matter for interest rates? Well, if I'm in selling bonds all the time, that's going to make the interest rate that the buyer demands go up. So the Federal Reserve is actually making long-term rates go up because they're selling massive amounts of bonds, right? So we have inflation, we have a federal government borrowing more money than they've ever borrowed, and we have the Federal Reserve consistently selling bonds. All of these factors are making interest rates go up. And if interest rates go up, stocks have to go down to have a higher yield to be competitive. That's why every day when you sit down at your terminal, you should be watching what's happening. What's happening in 5-year notes? What's happening in 10-year notes? What's happening in 30-year bonds? What's happening in TLT, the ETF for 20-year, essentially 20-year bonds? What's happening in IEF, the 7 to 10-year ETF? Watch those. And when they're making new lows, you know that your stock portfolio is likely going down. What day is it? That's right, it's Tuesday. And it's not just any Tuesday, it is Trader Tip Tuesday, where I come to you with tips like today, the warning about watching the rate in the 10-year note, watching the yield that helps you take your performance to an elite level. I'll see you next Tuesday.